Let's talk about beta. You've probably heard it tossed around when people discuss stocks, but what is it, and why should you, as an investor, even care? It's a core concept in understanding risk, and it can really help you build a smarter, more informed portfolio. Beta is essentially a measure of a stock's volatility in relation to the overall market. Specifically, it tells you how much a stock tends to move up or down for every 1% move in the broader market, usually represented by an index like the S&P 500. Think of it like this. The market is a boat, and individual stocks are passengers. Some passengers stay relatively calm even when the boat rocks. Those are low-beta stocks. Others get tossed around wildly with every wave. Those are high-beta stocks. A beta of 1 means the stock tends to move in line with the market. If the S&P 500 goes up by 1%, the stock is expected to go up by 1% as well. If the market drops 2%, the stock is likely to fall 2%. Pretty straightforward, right? But things get interesting when the beta isn't 1. A beta less than 1 suggests the stock is less volatile than the market. Let's say a stock has a beta of 0.5. That means if the S&P 500 goes up 1%, this stock is only expected to rise 0.5%. Conversely, if the market falls 1%, this stock is predicted to drop only 0.5%. These are generally considered safer investments, particularly during market downturns. They won't give you the same gains when the market is soaring, but they'll cushion the blow when things go south. Now let's look at a stock with a beta greater than 1. A beta of 1.5, for example, means the stock is expected to move 1.5% for every 1% move in the market. So, if the S&P 500 jumps 1%, this stock might climb 1.5%. But the downside is also amplified. If the market falls 1%, this stock could potentially drop 1.5%. These are considered riskier investments with the potential for higher rewards, but also higher losses. Let's use some simple examples. Imagine you're looking at two stocks. Stock A has a beta of 0.8 and stock B has a beta of 1.2. Let's say the S&P 500 increases by 5%. Stock A, with its lower beta, might only go up around 4%, 5% x 0.8. Stock B, with its higher beta, could potentially jump around 6%, 5% x 1.2. Now let's flip the script. The S&P 500 drops by 3%. Stock A might fall around 2.4%, 3% x 0.8, while stock B could drop around 3.6%, 3% x 1.2. These are, of course, just estimates. Beta is based on historical data and doesn't guarantee future performance. Many factors influence a stock's price, but it's a useful tool for understanding its potential volatility relative to the market. Why is this relevant for U.S. investors? Well, understanding beta helps you build a portfolio that aligns with your risk tolerance. If you're a conservative investor who wants to minimize risk, you might focus on stocks with low betas. These stocks will likely provide more stable returns, even if they don't offer the same potential for rapid growth. If you're a more aggressive investor willing to take on more risk for potentially higher rewards, you might include some high-beta stocks in your portfolio. However, it's crucial to remember that higher potential returns come with increased risk of loss. Beta also helps with diversification. By combining stocks with different betas, you can create a portfolio that's less sensitive to market fluctuations. A well-diversified portfolio will generally provide more consistent returns over the long term. Where do you find beta information? Most financial websites like Yahoo Finance, Google Finance, or Bloomberg will provide beta figures for publicly traded stocks. Just search for the stock symbol and look for the Statistics or Key Statistics section. It's also important to understand the limitations of beta. It's calculated based on past price movements, and past performance isn't necessarily indicative of future results. Beta only measures volatility relative to the market. It doesn't consider other important factors like a company's financial health or industry trends. Furthermore, beta can change over time as a company's business and market conditions evolve. Think about a tech company that's still in its early growth stages. Its beta might be higher because its stock price is more sensitive to investor sentiment. But as the company matures and becomes more established, its beta might decrease. So, while beta is a useful tool, it shouldn't be the only factor you consider when making investment decisions. Do your research, understand the company's fundamentals, and consider your own financial goals and risk tolerance. In summary, beta is a measure of a stock's volatility relative to the market. A beta of 1 indicates similar volatility, less than 1 suggests lower volatility, and greater than 1 suggests higher volatility. It's a valuable tool for understanding risk and building a diversified portfolio, but it's important to remember its limitations and consider other factors before investing. Remember, this information is for educational purposes only and should not be taken as financial advice. Always consult with a qualified financial professional before making investment decisions.